Celsius is down 75% from its peak less than a year ago. In this video, we will analyze if now is the perfect time to buy the stock. We'll examine financial performance, future growth, and valuation. For those unfamiliar with Celsius, here is a quick company overview. Celsius was founded in 2004 and specializes in premium, zero-sugar energy drinks, aimed at promoting active lifestyles. Marketed as a healthier alternative to traditional energy drinks, Celsius has successfully positioned itself as a key player in the industry, appealing to fitness enthusiasts and health-conscious consumers. One of its major strategic partnerships is with PepsiCo, which with its distribution network will significantly accelerate Celsius sales. At least this is the plan. So now, let's look at some numbers. Over the past 10 years, revenue has grown at an impressive CAGR of 51.4%. If we narrow it down from 2019 to today, the CAGR jumps to almost 105%. Gross margins expanded from 40% in 2014 to 48% in 2023, though there have been fluctuations along the way. Celsius as a young company has struggled with its profitability at first. It became profitable in 2019 and it remained so except for 2022, when it reported a 199 million loss, primarily due to one-time expense of 186 million because of a long-term distribution agreement with PepsiCo. But there is another story to the income. If you look at the operating income, we can see that the company was profitable only twice, in 2020 and in 2023. The reason the net income is positive is due to the other investments Celsius made, including interest the company gets on their cash. EBITDA, mirroring net income, it has mostly been negative, turning positive only in 2020 and 2023. CapEx has been increasing in relation to revenue in recent years, while cash flow from operations is generally aligned with EBITDA. It has been positive since 2019, except for 2021. When a 175 million inventory offset caused a dip. Free cash flow, calculated by subtracting capex from cash flow from operations, has been negative only in 2021 if you look at the recent history. One concerning factor is share dilution. Over the past decade, the company has diluted shareholders by nearly 20% annually. Even though this decreased to 5% per year over the last 5 years, it's still quite high. Lastly, before moving to the stock valuation, let's look at free cash flow from primary business. Here we sum together net income, depreciation and amortization, and deferred income tax. Then we subtract capex and common and preferred dividends to get the free cash flow from which we can understand if the company is really profitable from its core business. In this example, we can say it is 50%. If the 2024 numbers come out positive, then we might be set for a good future ahead. Now, let's move on to stock valuation. But before starting, this is not financial advice. To determine a reasonable price for the stock, we project revenue for the next 3 years, using 3 different scenarios. Bear case, a 0% revenue growth. This would be our baseline for risk assessment, to see how much growth is already priced in. For our base case, we'll use 15%, and for bull case, we'll use 25%. That is because if we look at the quarterly results, we can see that 2024 had slower growth and Q3 even saw a decline. Analysts expect Q4 to have a negative growth as well, so I would rather be more cautious, as if the analysts' numbers come out correct, the 2024 growth will be only at 3%. Moving on to margins. For net income, 5, 10 and 15% were used, while for EBITDA, 8, 12 and 20%. Cash flow from operations is adjusted based on historical relationship to EBITDA, but as EBITDA was for the most part negative, we will compare just last year's numbers, which gives us a cash flow from operations of 50% less than EBITDA. So 4, 6 and 10%. For CapEx, we set it at 1.6% across all scenarios. Using these projections, we estimate free cash flow ranging from 32 million on a low end to 138 million on a high end for 2024, while terminal value ranging from 268 million to 1.8 billion. Applying a discount rate of 14.6%, the present terminal value of the company falls between 204 million and 1.4 billion. If we now sum All up, we get a present value in our perpetual growth rate model. But here we can add in cash and subtract debt. And as they have almost no debt and quite some cash at hand, the present value increases substantially, from 1 billion at the low end to 2.6 billion at the high end. If we now divide with the number of current shares outstanding, we get a share price from $4.39 to $10.97. Now let's move on to EBITDA model, where we take 2026 EBITDA numbers and multiply them with the company and S&P 500 average multiple, the first being 18.6 and the second being 14.2. This gives us again a terminal value, which we need to discount to today, and divide it with the shares outstanding to get a stock price, which with company historical multiple, we get a range from $9.47 to $33.89, while for the industry average multiple, we get a lower $7.99, and on the higher side we get $26.67. This also includes cash and debt as in the model before. If we now blend perpetual growth rate and EBITDA multiples, we get a range of prices from $6.93 to $22.43 for the company average and $6.19 to $18.82 for the industry average. If we look at our averages from all numbers we went through, the stock price should be somewhere between $11 and $12.83, while with analyst numbers we get a range from $15.76 to $18.52. Based on our analysis, what should you pay for Celsius stock? Using a scoring system to evaluate the stock, let's again see where Celsius shines. Celsius earns 4 points out of possible 24. Its strong revenue growth and almost no existing debt is its strength, but share dilution is its weakness. The company currently does not offer any dividends. Considering the dilution factor, I would reconsider investing in the stock if it falls below $10. Given the current stock price, that's quite a gap. However, upcoming quarterly results could change this outlook if they outperform expectations. For now, I prefer to remain conservative and explore other opportunities with better risk-reward profiles, like ADM. While Celsius has strong growth potential, it is still a young and evolving company, and I would rather wait for a more favorable entry point. Let me know if you are currently holding or considering buying the stock, and I'll see you in the next video.